Without objection, the chair is authorized to declare a recess of the subcommittee at any time. Without objection, members of the full committee not on this subcommittee are authorized to participate in today's hearing. As a reminder, I ask all members to keep themselves muted when they are not being recognized to minimize the disturbances while members are asking questions of our witnesses. The staff have been instructed not to mute members except where a member is not being recognized and there is inadvertent background noise. Members are reminded that all House rules relating to order and decorum apply to this remote hearing. Members are also reminded that they may participate in only one remote hearing at a time. If you are participating today, please keep your camera on, and if you choose to attend a different remote proceeding, please turn your camera off. If members wish to be recognized during the hearing, please identify yourself by name to facilitate recognition. The title of today's hearing is Examining the Role of Municipal Bond Markets in Advancing and Undermining Economic, Racial, and Social Justice. I now recognize myself for 4 minutes to give an opening statement. Today's hearing will assess the municipal bond markets as a driver of systemic discrimination on one hand and of restorative justice on the other hand. First, it will examine material disparities in cost of capital raising for minority-serving institutions, more specifically, historically Black colleges and universities. Second, this hearing will explore the municipal bonds can drive positive change and promote fiscal justice, a truly exciting area of finance today, thanks to the efforts of some issuers and investors and some of those represented among the witnesses. Research authored by one of today's witnesses demonstrates conclusively that HBCUs pay higher underwriting fees to issue tax-exempt bonds compared to similarly situated institutions that are not HBCUs, thereby materially increasing their cost of capital. Notably, this analysis held constant the issuer's credit quality and default risk by comparing HBCUs and non-HBCUs having AAA credit ratings. As a result, timely payment of municipal bonds analyzed was virtually assured, and therefore any cost differential would not be the result of differing risk exposures affecting investor behavior. Rather, as we will hear from our panel, the disparities in fees were attributable to racial animus among investor pools. This conclusion is buttressed by the findings that cost disparities were magnified in states where anti-Black racial resentment is most severe. As the beneficiary of an HBCU education myself, these findings are at once both deeply personal and profoundly troubling. Specifically, the data show that HBCUs pay an average of 20% more to issue bonds than similarly situated non-HBCUs, with the size of this differential varying by state. To illustrate the magnitude of the disparity, consider that HBCU bond issuers in Alabama, Louisiana, and Mississippi paid 30 basis points more in fees than non-HBCU issuers in the same states. In all other states, by contrast, HBCUs paid issuance costs that were 11 basis points more than non-HBCU issuers, which paid an average of 81 basis points. In closing, I'd like to thank my longstanding colleague, Representative Adams from North Carolina, for her support of this hearing, and quite frankly, without her, the hearing probably would not be taking place. So at this time, I'd like to recognize the ranking member, my friend, Mr. Barr, for 5 minutes for an opening statement.
Thank you, Mr. Chairman. I appreciate you holding today's hearing, and I thank you to all of our witnesses as well for appearing today. The municipal bond market provides a reliable source of capital for municipalities to finance their long-term growth and a stable avenue for investors to put their money to work for the public good. The muni market is made up of a diverse group of over 55,000 issuers, ranging from state and local governments to local transportation authorities. Of the more than $3.7 trillion of municipal debt in the market, over 50% is held by individuals, with the remaining split between banks, mutual funds, insurance companies, and other investors. The muni market is a strong and reliable way for issuers to finance their operations. During the pandemic, the muni market experienced significant volatility and liquidity challenges. Widespread lockdowns, stay-at-home orders, and government-mandated business closures weighed on the economic well-being of states and localities as taxes, tourism, and other revenue sources declined. To respond to this challenge, Congress directed the Federal Reserve to establish the Municipal Liquidity Facility, and shortly after the establishment of this facility, the market normalized. The muni taxable and tax-exempt markets are now performing well after the initial shock of the pandemic. The quick stabilization of the muni market is evidence of the success of the Municipal Liquidity Facility. Some of my colleagues have said that the MLF should be evaluated on its take-up rate, suggesting the fact that only 2 issuers utilized the facility was somehow indicative of its failure. But I believe the opposite. The mere existence of the facility served as a backstop that allowed the private market to function properly in uncertain times. I think we can all agree that our nation's infrastructure needs improvement. We must repair, improve, and expand existing infrastructure such as roads and bridges, and invest in infrastructure for future generations such as rural broadband to ensure an equitable path toward the future of work and education. The question then becomes, how do we achieve our shared goals of strong, comprehensive, and resilient infrastructure? Municipal bonds are a key funding source for state and local governments to finance long-term infrastructure improvement plans. As Congress and the administration begin a dialogue on how best to improve our roads, bridges, and connectivity, we should assess all of the available options to pay for it. Significant tax increases would reverse the economic prosperity and growth realized over the last few years since the passage of the Tax Cuts and Jobs Act. It would certainly reduce wages and it would compromise American economic competitiveness. Instead, we should look for ways to incentivize and mobilize private capital. The muni bond market provides a mutually beneficial avenue to match investors seeking stable long-term returns with issuers seeking to improve their roads, bridges, and schools. I hope to use this hearing to investigate ways that Congress can improve the municipal bond market, both for issuers and investors. There are bipartisan proposals, such as reinstating advanced refunding for municipal bonds, that could expand access to needed capital for issuers and improve investors' access to municipal paper. I also look forward to learning more about the ratings process for municipal bonds. Bond ratings are an important factor that determine the interest cost of a security and inform investors' appetite for risk. Last Congress, I worked on a bipartisan basis with my colleague from Pennsylvania, Ms. Dean, to ensure equitable access to the Fed's emergency facilities for issuers, and that issuers were not excluded from the facilities solely based on the SEC-regulated rating agency they chose to work with. This effort was intended to help small businesses find liquidity and provide options for smaller municipalities. I would also emphasize the importance for investors that credit ratings be based solely on the creditworthiness of the issuer and not compromised by non-material information. Credit ratings based on subjective criteria derived from social or other political goals would pose challenges for issuers selling their bonds and may not properly inform the market of the issuer's ability to repay its debt. This hearing will also review a study that showed historically Black colleges and universities paid more to sell their debt compared to their non-HBCU peers. Discrimination in the municipal bond market is illegal, and it should not occur. To the extent that such discrimination exists, Congress, regulators, and market participants should work to ensure it does not persist. I share my friend and colleague, Mr. Green's personal interest in this. I didn't graduate from an HBCU, but I do have the privilege of representing Kentucky State University, and this is an important topic. I look forward to hearing from our witnesses about the important role the municipal bond market plays in our investment ecosystem. And again, I thank the chairman and I yield back.
The gentleman yields back, and the chair thanks the gentleman for his recognition of the most important issue. At this time, the chair recognizes for 1 minute the gentlewoman from North Carolina, Rep. Adams, who has been a tireless advocate for HBCUs throughout her career. Representative Adams, you are now recognized for 1 minute.
Thank you, Mr. Chairman, for granting me a minute of your time. It's a privilege to serve on the Oversight Committee under your leadership, and I'm grateful to you for holding this hearing. It's critical that we better understand the role that municipal bond market plays in advancing, or in some cases, limiting economic, racial, and social justice. As a two-time graduate of an HBCU, a 40-year professor at an HBCU, I'm particularly concerned that historically Black colleges and universities and other minority-serving institutions are getting a raw deal when it comes to accessing equal and affordable financing through the bond market. A 2019 study published in the Journal of Financial Economics found that HBCUs pay higher underwriting fees to issue tax-exempt bonds compared with similar institutions that are not HBCUs, thus raising the cost of capital for HBCUs. And this discrepancy is unrelated to the issuer's credit risk or quality. It's approximately 3 times greater in geographic areas of the United States where racial discrimination is most severe. I want to thank you for the opportunity to speak, and I yield back and look forward to hearing from our witnesses. Thank you, Mr. Chair.
The gentlelady's time has expired. At this time, the chair would welcome our outstanding witnesses, and I'm pleased to introduce our panel. Mr. Chris Parsons, who is Professor of Finance at the University of Southern California. William Fisher, who is Chief Executive Officer of the Rice Capital Access Program. Chelsea McDaniel, who is a Senior Fellow at Activest. Gary Hall, who is a partner and head of investment banking at Siebert, Williams, Shank and Company. And Jim Nadler, who is President and CEO of Kroll Bond Ratings. Witnesses are reminded that your oral testimony will be limited to 5 minutes. You should be able to see a timer on your screen that will indicate how much time you have left, and a chime will go off at the end of your time. I would ask that you please be mindful of the timer and quickly wrap up your testimony if you hear the chime, so that we can be respectful of both the witnesses and the committee members' time. Without objection, your written statements will be made a part of the record. Once the witnesses finish their testimony, each member will have 5 minutes to ask questions. Mr. Parsons, you are now recognized for 5 minutes to give your oral presentation of your testimony.
Thank you, Representative Green. Committee members, thank you for the opportunity to share the highlights of research I have conducted on the pricing and issuance costs faced by historically Black colleges and universities, HBCUs. My testimony today is based on the research manuscript, What's in the School Nation Higher Education Bond Markets, which was published in the Journal of Financial Economics in December 2019, which I have submitted separately to the committee. My co-authors on the study, Casey Dougal of Florida State, Ping-Ji Gao of Notre Dame, and William May of Duke University, pass along their regards. Economists have been interested in discrimination for many decades, and indeed have documented race and or gender disparities in wages, job placement and retention, home ownership, mortgage rates, access to capital, and dozens of other outcomes. A key empirical challenge, however, is that simply documenting differences in average outcomes between groups formed by gender, race, age, or other characteristic may not always paint a complete and accurate picture. The reason is because these or other characteristics may be correlated with other determinants of the outcome of interest. Consequently, it is rare to find examples where we can be almost certain that we have accounted for such competing factors other than discrimination itself. Although no real-world study can be 100% perfect in this regard, studying municipal bonds issued by colleges and universities provides a close approximation to this ideal. There are 3 reasons why. First, when you buy a bond, all that should matter is the financial return. That is, whether you're paid back according to the contract terms. Compared to labor markets or other settings, this simplifies the analysis, since the notion of the issuer's quality or productivity is well defined and relatively objective. Second, there is a well-accepted way of measuring an issuer's ability to pay called credit or bond ratings. By comparing two issuers with the same credit rating, we, as researchers, can account for credit quality in the same manner that investors do. Finally, in about half the cases we will study, universities with low credit ratings purchase credit insurance, which allows them to adopt the credit rating of the parent insurance company. In these instances, we can compare two universities not only with the same credit rating, but with the same insurance company, an extremely precise control for credit worthiness. With these advantages as a backdrop, we collect data on 4,145 college-issued municipal bond offerings between 1988 and 2010, of which 102 were conducted by HBCUs. Our analysis asked two questions. First, do HBCUs pay more in issuance fees versus non-HBCUs? Second, once HBCU bonds have been placed in the market, do they trade at lower prices or otherwise show evidence of discrimination by investors? The answer to the first question is yes. HBCUs pay about 20% more in underwriting fees, which are the ones that brokers sell or place with bond investors. This increases to 30% if we focus on states with historically high levels of racial animus, specifically in the U.S. Deep South. These analyses account for the fact that HBCUs may be smaller than non-HBCUs, may have different credit ratings, or may differ in other important ways. The answer to the second question, that is about pricing, is maybe. On average, HBCU bonds appear to trade at somewhat lower prices than otherwise similar non-HBCU bonds, but the differences are small and in most specifications are not statistically significant. We do find that when HBCU bonds are traded, it takes about 25% longer to find a willing buyer. What explains these results? Due to tax reasons, municipal bonds offer the largest advantage to investors residing in the same state as the issuer. What this means is that HBCUs, by virtue of being located mostly in the American South and Southeast, may face collective reluctance from what should be their most receptive investor base. If wealthy investors in their home states, due to racial animus, disproportionately shun HBCU-issued bonds, we would expect to find results similar to what we document in our analysis. Because underwriters have a harder time finding willing buyers, they will charge a higher commission. Critically, however, the effects of discrimination may or may not manifest directly in bond prices, because the higher selling efforts of underwriters should be and appears to be sufficient to secure prices that are close to fair market value. Of course, ultimately, this means that HBCUs do pay higher costs for accessing debt markets in either case, whether their bonds trade for lower prices or whether they simply pay higher issuance costs. One possible policy tool to help remediate these challenges would be affording HBCU-issued bonds tax exemption from state and local taxes. The effect of this policy would be to remove the tax disadvantages an investor living in, for example, New York or California currently faces when potentially investing in an HBCU-issued bond from another state. Thank you for attention, and I look forward to any questions you may have.
The gentleman's time has expired. Thank you, sir. At this time, Mr. Fisher, you are now recognized for 5 minutes to give your oral presentation of your testimony.
Good afternoon, Chairman Green and distinguished members of this committee. My name is William Fisher. I have over 30 years of experience in the municipal finance sector as a financial advisor, as an underwriter, and an issuer of tax-exempt and taxable securities for state and local governments. As a graduate of Howard University, I am also the proud parent of both a Tuskegee graduate and a third-year Morehouse School of Medicine student in Atlanta. I also have the privilege of serving on the Board of Trustees for Jarvis Christian College in Hawkins, Texas. I currently serve as the Chief Executive Officer of Rice Capital Access Program, the designated bonding authority for the historically Black college and university capital financing program for the United States Department of Education. HBCUs play a vital role in higher education that is not easily recognized or appreciated by the capital markets. The mission these institutions serve cannot be fully understood by mere examination of standardized test scores, selectivity metrics, and financial ratios. This lack of understanding subjects these institutions to higher interest rates when borrowing, as well as restrictive covenants that impair their financial flexibility. As a result, investments in physical facilities, student support initiatives, and academic programs suffer. These increased borrowing costs also increase the cost of attendance at these institutions on several levels. For example, increased costs associated with the financing of a dormitory are borne by the student through higher student housing fees. These increased student housing fees increase the need for students and their families to borrow additional funds to finance their education. This increased debt burden impacts not only the student and their families, but also the institution. As the committee is aware, institutions with a high cohort default rate are in jeopardy of losing access to Title IV funds and possibly its accreditation. The impact of expensive debt is not limited to the institution and its students. The local economy, the local communities are also negatively impacted. Several advocacy groups have completed economic impact studies on the value HBCUs bring to the local economy. In short, the presence of an HBCU fosters a vibrant community by providing employment opportunities and the purchase of goods and services. Expensive debt limits the institution's ability to fully engage with the local economy. When Congress created the HBCU Capital Financing Program, not only did it provide access to low-cost borrowing, but it created a path to financial stability. To further secure HBCU's place in America and higher education, the feasibility of the recommendations offered by the HBCU Capital Financing Advisory Board, which includes A, an increase in borrowing capacity of the program, and B, expanding the use of the program to include operating lines of credit, merit consideration. Thank you for the opportunity to appear before you.
Thank you, Mr. Fisher. Ms. McDaniel, you are now recognized for 5 minutes to give your oral presentation of your testimony.
Thank you. Good afternoon, Chairman Green, Ranking Member Barr, and members of the subcommittee. Sorry, is there feedback? It's a little, okay. Thank you. Thank you for the opportunity to appear before you today and discuss the role of municipal bond markets in advancing and undermining economic, racial, and social justice. My name is Chelsea McDaniel, she, her, hers pronouns, and I'm a senior fellow at Activest. Activest is an investment research firm that quantifies fiscal justice risk within the municipal bond market. We define fiscal justice as the analysis of public budgets at the intersection of fiscal health and racial justice. Our thesis is simple. Communities and public entities that treat their residents and clients more justly realize stronger fiscal outcomes over the intermediate and long term. We're not only critics of the market, but also market participants through efforts like the Fiscal Justice Municipal Investment Strategy we developed alongside Adesina Social Capital, or the Fiscal Justice Research Agency we're launching this year. Our work blends economic modeling, financial analysis, and social policy research, and we exist to protect savers and everyday municipal investors from taking hidden and uncompensated risks of the more egregiously unjust corners of the municipal market. Today, I'd like to present a high-level sectoral view of the post-secondary education institutions within the context of the larger municipal finance market. Broadly, we've seen that social and environmental risks have emerged within public entities like local governments and schools as a result of long-standing policies born out of segregation-era views of development and progress that have yet to be updated. Whether it's the $70 billion in municipal revenue that schools lose annually to corporate tax incentives, the $11 billion lost to exclusionary school discipline policies, the $2 billion for municipal settlements, or the $7 billion of excessive fines and fees disproportionately extracted from BIPOC communities. Inequitable public budgets serve as the supply lines fueling state-sanctioned, taxpayer-funded exclusion and oppression. U.S. local government finance is built on a long history of sordid financial practices, and the current public finance system does a poor job of integrating the true social and fiscal costs of racial equity into the evaluation of cities and bond issuances. The fiscal and budgetary cost of ignoring the fiscal justice risk is growing as the reported incidence and pricing severity of fiscal justice events are growing within government entities, including post-secondary institutions. In the world of post-secondary finance, Activest research has focused on ways in which predominantly white institutions, or PWIs, have been extractive as opposed to collaborative, let alone peacefully existing with MSI or minority serving institutions. Although PWI's fiscal justice risks have to this point been unpriced, their materiality is growing in real time, and the long tail risk of their behavior is likewise expanding. Recent examples of this include the recent $577 million settlement for HBCUs in Maryland, numerous institutions granting funds or some form of reparations to descendants of enslaved Africans who were sold into finance schools and or endowments, and finally post-secondary schools that race to become federally recognized HSIs or Hispanic serving institutions to capitalize off the growing Latinx population, where scholar Gina Garcia discusses what it means to move from simply enrolling Latinx students to actually serving them. From a credit perspective, we see MSIs as strong municipal investments as opposed to PWIs, which are evidencing a growing body of unpriced fiscal justice risks. Accordingly, we've developed a series of recommendations to counter the aforementioned fiscal justice risks in the post-secondary market. The first of these is accounting for equity research. We see the need for a study to track and quantify all of the federal and state funding withheld from MSIs from their inception and the estimated financial impact on states and federal government when these payments come due. This research has been partially completed for TCUs, tribal and tribal colleges and universities, through efforts like the Land Grab Universities Project, but more research remains for HBCUs, PBIs, and HSIs. We anticipate at least two components of this. The first would focus on long-term liabilities, which would be a historical account of the financial support that was denied or stolen from MSI since their creation. And secondly, the elimination of current liabilities. Thank you so much for your time, and I look forward to any questions.
Thank you, Ms. McDaniel. Mr. Hall, you are now recognized for 5 minutes to give an oral presentation of your testimony.
SIFMA commends the members of this subcommittee for your collective focus on these important issues. I currently sit on the board of directors of SIFMA, which is the leading trade association for broker-dealers, investment banks, and asset managers operating in the U.S. and global capital markets. I am also a partner and the national head of infrastructure and public finance investment banking at Siebert Shank, the nation's largest minority-owned investment bank and a SIFMA member firm. As I described in my written testimony, I am extremely proud of my firms, my families, and my strong connections to HBCUs. Hence, I would like to join SIFMA by expressing appreciation on behalf of my firm, my family, and myself to the subcommittee for bringing attention to HBCUs having fair access to the public municipal bonds market. My career in the municipal bond markets includes serving as an issuer, a lawyer, and a banker. I'm the immediate past chairman of the Municipal Securities Rulemaking Board, the self-regulatory organization that safeguards the $4 trillion municipal securities industry. Therefore, I know firsthand how municipal bonds are a critical funding source for infrastructure in America. As it pertains to the subject of this hearing, I would like to first emphasize that SIFMA and its members are committed to fair pricing. While I'm always appreciative of being able to learn from scholarly research and academic analysis, I do believe there are certain contextual considerations that warrant highlighting with respect to the study that spurred this hearing. I detailed these considerations in my written testimony. However, in sum, I can tell you that the municipal market has undergone seismic changes with respect to pricing transparency, regulatory framework, technological transformation that would mitigate many of the conclusions reached in the study. Again, my written testimony outlines these considerations in more detail, and I'm happy to answer any questions from members of this distinguished panel, including my classmate, Mr. Fisher. Despite my and SIFMA's concerns as it pertains to the study, We fervently believe more can be done to assist HBCUs with accessing the capital markets for more cost effectively. Specifically, SIFMA supports authorizing triple exemption for HBCU-sponsored debt. Ironically, the study too suggests that providing HBCUs with the ability to attract a larger pool of investors would contribute to favorable pricing in the capital markets. I believe this idea is spot on and perfect for the current market environment, given the strong appetite for social impact bonds, a subset of ESG bonds. Social impact investors would highly covet HBCU issued debt, whether such was tax exempt or even taxable. Hence, ways to expand the taxable investor base for HBCUs include having the federal government authorize a high subsidy direct pay bond, similar to disaster recovery bonds. Moreover, authorizing a federal guarantee on taxable direct pay bonds for HBCU-sponsored debt would be a valuable credit enhancement to attract a new class of investors for these bonds. With respect to the overall bond market, please know that SIFMA supports, as Ranking Barr mentioned, reinstating tax exemption on advanced refundings of municipal bonds, expanding private activity bonds, reinstating a direct pay program similar to the Build America Bond program, especially in light of the infrastructure legislation that is currently under consideration. Adding these tools will be valuable to helping state and local governments both address critical infrastructure needs and obtain savings that filter down to taxpayers. Again, I commend the work of this subcommittee on this important topic, encourage lawmakers to favorably consider the policy proposals that SIFMA supports, and thank you for having me, and I look forward to answering your questions.
Thank you, Mr. Hall. Mr. Nadler, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Thank you. Good afternoon, Chairman Green, Ranking Member Barr, and members of the subcommittee. Thank you for the opportunity to testify today. My name is Jim Nadler, and I'm the President and CEO of Kroll Bond Rating Agency. Since KBRA's founding in 2010, we have been a vocal proponent of the importance of open competition in the credit rating space to protect investors and increase market liquidity for underserved sectors. And we greatly appreciate the work of this committee in advancing that goal, including by unanimously passing legislation through the House last year. Today, KBRA, an SEC-registered credit rating agency, has more than 400 employees in offices in the United States and Europe, has issued more than 42,000 ratings, representing $2.2 trillion in rated issuances. KBRA is currently one of the 5 largest rating agencies globally, and the largest established after the Great Financial Crisis. We rate over $364 billion of municipal debt, nearly 10% of the total outstanding debt in the market. Our ratings add important insight for investors across a wide variety of municipal issuers, including states such as Texas and the Commonwealth of Kentucky, cities including Dallas, Chicago, and Los Angeles, transit systems such as New York's MTA, airports like DFW, Chicago O'Hare, and large municipal utilities such as Los Angeles Department of Water and Power. In observing the bond market in 2020, the municipal market was significantly impacted by the outbreak of COVID-19. The effect of the pandemic was uneven, varied city to city and state to state. Initially, the cost of issuing debt increased considerably, especially for issuers with lower rated debt. Municipal issuers did benefit from the historic federal government intervention, both in terms of direct infusion of funds and monetary policy. And the municipal market today is more stable than many municipal observers expected. As we look to the future, we believe that some states and municipalities will come out of the crisis stronger, but this may not be true for those municipalities that had pre-existing structural deficits in their budgets. Some states and municipalities may find that their particular economy may be fundamentally altered for some time, including those dependent on long commutes to downtown office districts, as well as leisure and business travel destinations. Moving to the topic of social and racial, the economics, racial and social issues, I'd like to address their impact on municipal bonds. Municipalities, by their very nature, have material attributes of positive social impact that deserve amplification. Some do not, and those that do not will suffer by not having that type of analysis to show on their behalf. Many of these attributes are not included in the separate ESG scores that are proliferating in the market, particularly in the areas of health, safety, housing, and education. In our view, investor preferences will continue to drive pricing and liquidity in favor of municipalities that have exhibited a commitment to economic, racial, and social justice. Mr. Chairman, knowing the subcommittee's interest in the ratings of historically Black colleges and universities, I would also like to provide our perspective on that topic. While KBRA is not significantly involved in rating institutions of higher education today, our general observation is that competition among ratings and research has dramatically increased the quality of research and underpinnings of those credit analysis. As has certainly been our experience in the community bank space, we believe that sunlight is the best disinfectant and that HBCUs would benefit from better, more thorough analysis and research to ensure that their ratings are based on consistently applied and fair assessment of credit quality. Mr. Chairman, I thank you and the subcommittee for the opportunity to testify today, and I look forward to any questions.
Thank you, sir. The gentleman yields back the balance of his time, Mr. Nadler. At this time, the chair will now recognize Mr. Cleaver, the chair of the Housing, Community Development, and Insurance Subcommittee, for 5 minutes for questions. Mr. Cleaver, you're now recognized.
Sorry for the delay, Mr. Chairman. Thank you very much. And I'm particularly thrilled that you called this hearing. I would like for, Mr. Thompson, Mr. Hill, all of our witnesses to think about what I'm getting ready to ask and what I will ask, and we'll try to get a response. You probably are going to wonder how the DOJ's patterns and practices fits into a committee hearing on municipal bonds, for example. And I'm not sure if all of you, like Mr. Green, well, Mr. Green's not a native Texan. I'm a native Texan. I grew up in Texas and became quite familiar with a lot of the communities around Texas. I discovered early on when I moved to Missouri after HBCU, Prairie View A&M University, that Missouri had, I think, 7 sundown towns. And one of the sundown towns has become famous. It's called Ferguson, Ferguson, Missouri. Now, if you're not familiar with what a sundown town is, I'm sure that Mr. Hall and others are, but it means that if you were African American, by the time the sun set, you had to be out of that town, or could face just about anything from a beating to death. And they were all over the country. They were not just in Missouri, in Texas. We had a town with the banner up across the street that said, this is the whitest town and the blackest dirt. And we had to deal with sundown towns in Missouri, of course. And so it may be of some surprise for you to know that Ferguson is a town of about 21,000 people. And yet, Ferguson police issued, based on the patterns and practice study of the Department of Justice, they issued 32,000 traffic tickets a year. Listen again. Population, 21,000. The police issued an average of 32,000 tickets a year, traffic tickets. We call that policing for profit. And so they did millions and millions of dollars in fines to finance the government of Ferguson, Missouri on traffic tickets. It's not Emmanuel Cleaver's analysis. It's not what I think. I mean, these are facts that were brought out when the patterns and practice report was issued on Ferguson, Missouri. So how does that fit in? Well, if you have a town where you had revenue-focused policing and a declining tax base, it means that you're going to have a difficult time getting anything done as a municipality. And so I'd like for our witnesses to accept the fact that you can challenge me if you want. I'll win, but you can challenge what I've said. But how many of you believe that socioeconomic factors like poverty, like income inequality, the availability of affordable housing, unemployment or employment, diversity of employment, all factor in on a risk of a municipality and their ability to get significant bonding? With all of the things I just mentioned, which is a fact, it's a fact. What do you think Ferguson's ability to get bonding would be? And how many people would say, well, race has nothing to do with this? It's the city is just poorly run. But race has been the major factor in that inability to get funding. So who would like to clear this up for me and then give me, Mr. Thornton, some ways in which we can prevent this from continuing to happen?
Representative Cleveland.
Yes.
This is Gary Hall. The only thing that I would significantly challenge in your supposition is you mentioned these towns having sort of restrictions. I grew up in Chicago, and I would also say that neighborhoods had the same sort of restrictions that you mentioned. So it's not just pursuant to towns. I don't know if the chairman wants me grant me additional time to try to answer the question.
The chair will grant an additional 30 seconds.
The bottom line is that while I can't speak to the specific credit nature of Ferguson, I can tell you that a lot of considerations are taken into fact when we're going into the municipal bond market. The socioeconomic background is not as important as the economic power and tax base. And that's something that we evaluate a lot working with our issuers for access to the bond. As evidence of the fact that during the pandemic, we did a transaction, my firm, for a convention center in St. Louis. And as you might know, the convention centers during the pandemic were not readily visited. So that's a statement to the ability to navigate tumultuous sort of market conditions to even access the capital markets during tough times.
Thank you. Thank you, Mr. Chairman.
The gentleman's time has expired. The chair now recognizes the ranking member, Mr. Barr, for 5 minutes for questions.
Thank you, Mr. Chairman. Let me ask Mr. Nadler first about market performance during the pandemic and the municipal liquidity facility. I was somewhat surprised that there wasn't as much uptake. There's been so much conversation about the plight of state and local governments during the pandemic and the decline in revenues. And of course, we did find out that large municipalities' revenues actually went up during the pandemic. But we were somewhat surprised after supporting the MLF that there wasn't as much uptake. And throughout the pandemic, really, the municipal bond market proved to be very resilient. The market certainly benefited from support from the Federal Reserve through the MLF, but maybe that was more psychological than actually through utilization. But it did perform well, and we avoided the worst case scenarios some feared. So, Mr. Nadler, where do you see the municipal bond market moving in the future post-pandemic? How has the market changed? And can you speak to whether or not we actually needed the bailouts of the state and local governments? If we had just encouraged municipalities to utilize the MLF, maybe they would have just been as well off.
Thank you, Representative Barr. I think that you mentioned a couple of things that are true. I do think that we were surprised as well by the few number of people that took advantage of the facility. I do think that the mere fact of the facility, along with very aggressive monetary policy, did have a very large impact on the psyche of both municipal issuers and municipal investors. And so I think that had much to do with how quickly we saw the municipal market move back to some semblance of normalcy. Second thing I'll say is that the impacts going forward are going to be uneven. There were structural issues before the pandemic, and we're going to see those exacerbated after the pandemic. And they're going to be in towns that were primarily vacation destinations. It's going to take a while for those to come back. I mentioned towns that have where they have a lot of commuters coming into the city. It's going to be a while before commuters feel comfortable getting on mass transit again in large numbers. And so I think the recovery, while it's been great and been, I think, faster than most participants thought, we will see an unevenness to it going forward.
Let me ask you about materiality. A bond rating is a significant factor that affects the interest cost of a security and helps inform investors' demand for bonds. What is the process, Mr. Nadler, for evaluating a municipal bond for the purposes of issuing a rating? What criteria go into assigning a rating for a municipal bond? In other words, what factors does Kroll consider to be material to a bond rating, and why is materiality so important?
Materiality is huge, and I think that is one of the most important factors. So when you're thinking about a bond rating and an actual credit rating on whether it's a municipality or a company, you really need to make sure that what you're analyzing really does have an impact on the fiscal health of that entity, whether it's a city or a state. Importantly, I think that we found that disclosure along these lines is probably one of the most important aspects. The second thing I'll say is that there are aspects of municipal bonds that are impact the liquidity of that bond going forward. And they may not necessarily impact the credit worthiness today. They may not have a material impact on it, but they would be interesting to investors, and investors are asking for that type of information. And so we are advocates of more disclosure, particularly the type of disclosure that may align with investor preferences over time and may also give investors insight into the liquidity issues around some aspects of bonds.
Well, in my remaining time, let me just turn to Mr. Hall very quickly. I'm a co-sponsor of bipartisan legislation investing in our Communities Act, which would reinstate advance refunding for municipal bonds. Mr. Hall, could you detail how reinstatement of advance refunding, especially with low interest rates, how that would help municipalities and issuers?
Absolutely. We are in an unprecedented time of low interest rate environment and budgetary stress on state and local governments. The ability to refund existing debt with lower tax-exempt debt is a valuable tool and really needs to be reinstated.
Thank you. I yield back.
The gentleman's time has expired. The chair now recognizes the little lady from North Carolina, Ms. Adams, for 5 minutes for questions.
Thank you, Mr. Chair. Again, thank you for hosting this meeting today. Professor and I want to thank all of the witnesses. Professor Parsons, first I want to thank you and your colleagues for your research that shows that HBCUs pay higher underwriting fees to issue tax-exempt bonds compared with non-HBCUs. And without this data, we would not be able to have this conversation today. So I do thank you. Your study found that unrelated to user credit risk or quality, underwriting fees are 3 times larger in certain areas of the United States. And you also found that HBCUs pay an average of 20% more to issue bonds that are similarly suited to non-HBCUs. Very succinctly, can you share what do you do to attribute this significant differential? And have you attempted to quantify the collective costs to HBCU bond issuers of this premium? And how would you begin to quantify that cost over the decades?
So that's a complicated question. The total costs, if you just want to look at the dollar amounts that are specifically implied by the differences in underwriting costs, 20 to 30 basis points on a $50 million bond issue is in the hundreds of thousands of dollars. So it's not several millions, it's in the hundreds of thousands of dollars. Now, hundreds of thousands of dollars, you can quantify that lots of ways. That's a couple of professors, maybe it's 10 scholarships. But again, these are going to depend on the size of the issue for any one bond. One of the things that I wish our study could do that we simply cannot do is look at the decisions to issue bonds that were not taken because of higher underwriting costs. So you can compare the wages of two people in the job market. What you cannot compare is the wages between someone that's in the job market and someone who's not in the job market because they don't have a wage. And so everything in our study, and indeed every empirical study of this kind, is going to be conditioned on bonds that successfully went to the market. That's going to naturally lead you to an estimate that's a lower bound on the all-in costs, because we don't observe what happens to HBCUs that were not able to go to the market. My intuition, this is outside the realm of the study at this point. This is a supposition. My intuition is that cost is probably significantly larger for the firms, for the HBCUs that did not go to market.
Okay, great. Thank you. Ms. McDaniel and Mr. Hall, what are some other solutions that you might propose to help address these disparities?
I'll take the first crack at it if you don't mind. First of all, Congresswoman Adams, I just want to applaud you for your advocacy for HBCUs and your work in ensuring that over $1 billion of financing was forgiven in the capital financing program. That was a huge benefit to HBCUs. So thank you for your outstanding work. To the notion of your question, two things. The proposal, the study actually mentions this whole notion of expanding the tax base for HBCUs, which SIFMA supports by incenting by having triple tax exemption for HBCUs. Thereby, states debt issued in North Carolina would be attractive to investors in New York and California, where the income tax state income is high, and the incentive would be higher as well. Additionally, having a direct pay program similar to Build America bonds, where the HBCUs can tax the taxable market, a wider investor base over $9 trillion versus $4 trillion, will be another way to allow HBCUs to increase the demand for their bonds and close their overall cost of borrowing.
Okay, Ms. McDaniel, do you have a comment?
Yes, thank you. I think from our perspective, and when we look at the municipal bond market in general, we look at the things that aren't being accounted for. So we here know that HBCUs are amazing and outperform in terms of producing whether it's doctors and graduates, Black graduates at a higher success rate. And so I think it's looking at some of those different factors that aren't typically folded into the credit worthiness assessment of municipal bonds, including those, and how we view HBCUs. Similarly, how we're viewing PWIs that seem to get a positive boost in their ratings, but don't have similar outperformance for African-American students. So, sorry, and I'll yield back my time.
Thank you very much. Mr. Chair, I yield back. Thank you.
Gentlelady yields. The chair now recognizes the gentleman from Tennessee, Mr. Kustoff, for 5 minutes for questions.
Thank you, Mr. Chairman, and thank you for convening today's hearing. Thank you also to the witnesses who are here as well. Mr. Hall, if I could, with you, when you look at evaluating a municipal bond deal, can you talk about what are the most important factors that impact the structuring of any issuance, the fee structure, the eventual cost of capital for the issuer of the bonds?
Sure. Thank you for the question. First and foremost, we have to evaluate the credit underpinnings of the specific issuer, making sure that investors have confidence that they will be repaid. And what are the sort of the revenue triggers that will allow for debt service to be repaid? Secondly, and one of the things that I thought the study did not highlight enough is the actual size of the issuance and whether or not it would actually be very liquid in the market. Smaller bond issuances are less liquid than larger issuance. Issuers who are infrequently in the marketplace are less liquid than those who are frequently in the marketplace. And so the liquidity of the issuance would be a very important factor into the actual resonance of the bond in the market. All of those things are taken into consideration when you're evaluating the risks associated with the issuance, when you're evaluating the likelihood of success in the bond market, whether or not you would incur any sort of inventory risk in having those bonds in your inventory, and how long it would take to get the bonds out of your inventory, and very important to the overall receptivity of the bond in the capital markets.
Thank you, Mr. Hall. Can I also ask if you would to expand on working with higher education issues? You all talked about that somewhat in your testimony. Specifically, can you talk about what the market is like for those types of issuances for higher education, and how does that compare to other types of available debt within the market?
Well, one of the key components of the credit structure of higher ed is the size of the endowment, the student mix, the different sort of sources of revenues that the higher education entity has. Critically important. I would tell you, as I mentioned in my written testimony, there is peak demand for social impact bonds in the current market. Just to give you an example, we had over $150 billion of social impact bonds placed in 2020. The year before, it was less than $20 billion. And so higher education, even K through 12 education, given the investment objectives of certain ESG investors, are extremely attractive and most incur a pretty low cost to borrow in doing the competition for those bonds in the current marketplace.
Thank you, Mr. Hall. Mr. Hall, if I could shift gears with you for just a moment and talk about the importance of municipal bonds as a tool for individuals who use it for financial planning and certainly for saving for retirement. Can you speak about the individuals and the households that incorporate municipal bonds into their financial planning, and obviously the specific benefits of including municipal bonds into an investment portfolio?
Absolutely, sir. We are pretty fortunate in this country to have the ability for citizens to actually invest in their own communities by owning municipal bonds. You know, whether it be the Erie Canal or the Golden Gate Bridge, all were funded by municipal bonds, and having actual citizens being able to take a piece of those worthy investments. For a long-term investment vehicle on a risk-weighted basis, municipal bonds offer a pretty significant return relative to a risk weight on the corporate side, if you think of the after-tax benefit. And the benefit of these bonds are sort of evidenced by the fact that over 50% of our market is held by mom and pop investors in their households. It's changing, it's evolving as to how that access is granted these days, but it's still an important feature of the investment objectives of our everyday American citizens.
Thank you, Mr. Hall. And I have about 30 seconds left, Mr. Chairman. I'll yield back my time. I do thank the witnesses. Thank you for calling today's hearing.
The gentleman yields back his time, and the chair thanks the gentleman. The chair now recognizes the gentle lady from Michigan, Ms. Talib, for 5 minutes for her questions.
Thank you so much, Chairman. I know that whenever we experience an economic crisis, it's the budgets of states and cities that are hit the hardest. And I've seen that firsthand, the devastating impact of the bankruptcy of the city of Detroit and the impact it had on its residents and also the retirees. So last year, despite more than 1.5 million public sector layoffs across the country, the Fed's municipal lending facility only purchased 2 municipal bonds, amounting to less than 1% of the facility's capacity. And I know the Brookings Institute did find that the municipal lending facility's initial eligibility excluded countless communities like mine, including not only Detroit, but Atlanta, Baltimore, Boston, Pittsburgh, metro statistics areas. And so meanwhile, the Fed's secondary market corporate credit facility purchased hundreds of millions in corporate bonds in the energy sector, including from dirty polluters like ExxonMobil, Chevron, BP, and Marathon Oil right here in my district. So Professor Parsons, at this point, the Fed has been unwilling and unable to facilitate meaningful emergency assistance for states and local governments. How do you think our role as Congress should step in to fill this gap in fostering long-term investments in our communities?
Well, I can speak only to, I'd like to speak rather specifically to the results of the findings specifically with HBCUs. And one of the ways that I think about the triple tax exemption is it's almost a free market solution to a problem. One could characterize it that way. If the problem is that the market is too small, in the sense that if you're an HBCU attempting to place your bonds in the hand of less than willing investors, and that investor base is too small, triple tax exemption essentially opens up the market to other states where you give other investors a crack at it. So that's something I'm quite optimistic about, and I would support that very much if that were something that were on the table.
You know, as COVID and the pandemic has threatened our city and state governments with fiscal crises, I mean, they're in survivor mode right now. Unlike any other time or experience I've seen. I know that public banks could offer a much more, accessible option for dealing with these debts and investing in traditional underserved communities. I know in 1919, the state of North Dakota established a public bank which conducts business on behalf of the state, bringing down borrowing costs on the state needs and offering limited banking services to state residents. For example, I don't know if the chairman knows this, according to the Bank of North Dakota's 2020 report, the bank financed $36 million in school construction at a lower cost. So, Ms. McDaniel, do you believe that a public bank would be more likely to consider other factors beyond mere profits in issuing bonds compared to private bond underwriters, compared to a private bond underwriter?
Yes, thank you for that question, Representative. Well, based on the research by the ACRE, the Action Center for Race and Economy, municipal banks definitely allow cities to recapture local tax revenues. And local funds currently invested in market instruments retain those tax revenues currently siphoned off by payments of the principal and interest to municipal bond owners. So that's a definite advantage there. And they enable the municipality to channel that back into affordable housing, infrastructure, economic development. So I would definitely agree with what you said about public banks and the advantages there in being able to consider different factors with that, and also providing potentially more for the cities in terms of services that I previously mentioned.
Thank you, Ms. McDaniel. You know, what you said is basically the money stays within the community. And again, is be able to reinvest and again, help, I think, improve the quality of life of many of the residents. Professor Parsons, I mean, you heard what Ms. McDaniel said, and I would love to hear from you. How could public banking ensure traditionally underserved cities like mine gain access to resources and are better equipped to weather budget crises that were created by COVID and other really critical time in our country, especially the last Great Recession in my city?
My main observation about public banks is they serve a role when the private markets are, for whatever reason, failing or struggling, when there are frictions in that market. During COVID, the Fed was buying up basically everything. They were buying up municipal bonds and other fixed income instruments. One could imagine a similar intuition here.
All right, thank you. I yield, Chairman.
The gentlelady yields. Thank you. And the chair now recognizes for 5 minutes the gentleman from Illinois, Mr. Garcia, for his questions.
Thank you, Mr. Chairman, and thank you for holding this meeting to you and Ranking Member Barr. And of course, thank you to all the very informative witnesses for joining us. This hearing is especially important to me because we have to think a lot about the bond market where I come from. I represent parts of Chicago and suburban Cook County. Because our municipal bonds have attracted low ratings, our borrowing costs are high. That usually cuts to wages and benefits for working class people like the constituents I represent, and bigger checks for bondholders. Many of my constituents are from Puerto Rico, so they know this dynamic very well. We even have some of the same activist bondholders like Aurelius Capital calling for cuts in spending. It often means like the less money you have, whether you are Chicago, Puerto Rico, or a small university trying to keep the doors open, the more money you have to pay. Mr. Nadler, it seems to me that a lot of what goes into credit ratings is outside of issuers' control. For instance, if Puerto Rico is devastated by a hurricane, or Detroit loses thousands of good jobs because of changes in national economic policy, these would have a major impact on bond ratings. We know that communities of color and working class neighborhoods are hit especially hard by these kinds of shocks. Do rating firms consider whether their criteria for have a disparate impact on communities like mine, in your opinion?
I think that they don't do a good job of that. And I'll give you an example of your city, Chicago. So Chicago Public Schools. There was a point with the two main rating agencies, the two largest rating agencies had Chicago Public Schools at non-investment grade. We did a much larger study and looked at the housing market, basically the wherewithal of the city of Chicago, and found that they could sustain higher taxes if they needed it, and that there was no reason that school district should be non-investment grade. Now they've sort of come back to the investment grade. So I think that competition is important, because I think that when you're looking at whether it's Puerto Rico or whether it's the state of California, making sure that you've got competing ideas and that you've got enough research out there for investors so that they can use their preferences to choose where they want to invest their money is important. So I believe competition is important. And I will also just say one other thing, that a lot of times these incumbent rating agencies get into a rut, and they just look at the same things every year, every month. And instead of reimagining and relooking at cities and states as they grow and evolve. And I think it's important to take a new, fresh look at all the different entities that you pointed to.
Thank you, Mr. Nadler. Ms. McDaniel, it sounds like some bond issuers face financial troubles that can't be fixed with more debt, whether it's a university with a declining student body or a city with a declining tax base. Is the bond market itself capable of protecting these institutions from arrangements that just extract wealth from local communities? And do you think that a public bank or a national investment authority could provide better results?
Thank you, Representative, for that question. I think we've seen that in the case of certain cities, there have been in our recent past, as you mentioned, Puerto Rico, we can add Detroit to that list, and others, there's been unfortunate exploitation, I believe, of these cities and their tax population, whether because there's declining tax base or other reasons. And I think there's definitely a need for different institutions that can hold both the impact to the communities and the financial considerations at the same time. I think there's definitely, yes, so to your point, I think, yes, that may be something that a community bank or a public bank, I'm sorry, could better serve in that role, taking those into consideration. Thank you.
Thank you very much. Mr. Chairman, I yield back.
Thank you. The gentleman yields back. The chair now recognizes the gentle lady from Texas, Ms. Garcia, for 5 minutes for her questions.
Thank you, Mr. Chairman, and thank you to all the witnesses who appeared today. And Mr. Chairman, as you know, this is also for me something that's close and personal, as I served as in my first elected position as the city controller in Houston. I know I've done work with Rise Financial. I've done work with Muriel Siebert before the start of the firm of Siebert, Branford, and Shank. So these issues are really important. And it's regrettable that people don't realize how important they are, as my colleague, Representative Garcia mentioned, how it's all connected to what happens in a community. with regard to the jobs and the wages and the impact to the everyday workers. So thank you for holding this critical hearing. And I do want to start with you, Mr. Hall. I want to piggyback on some of the question that my colleague, Ms. Talib, was asking about the municipal facility. You know, it just didn't work. And a lot of it was the high penalty fees. A lot of it was that they initially excluded most of the Black cities in America. You know, my question to you is it needed? And if we were to bring it back, what changes do we have to make?
Well, two things let me say at the outset. I happen to know personally and professionally the people that the Fed tapped to run that program, and I have the utmost respect for them in both their professional and personal characters and abilities. So I think that's important. But I also think it's important to note the time that program was enacted. First of all, $500 billion was the size of that program. That's larger than the entire municipal bond market. We've never issued $500 billion. So I think the intent of the program is to be sort of shock and awe, to make sure that investors knew that the Fed and Treasury were behind the municipal bond market. And I think that worked. We had 20 billions of outflows in early March of 2020. And we were really suffering from a liquidity crisis. After the MLF program came in, we started seeing access to the municipal bond market, so much so that by the end, in October, we had the largest issuance of any month that we've had in the history of our market. I attribute a lot of that to the early efforts on the back of Congress and the MLF in providing stability. I know it was only 4 issuers and 2 issuers benefited from that. And they afforded tremendous amount of flexibility, not just in the cost of borrowing, but actually the terms that were really important for those particular issuers. But the overall benefit to the marketplace in providing stability was a huge objective of the MLF. And from that score, I think it really achieved its objectives.
But do we need to do it? And if we do, what changes? What's the question?
Well, right now, the municipal bond market is extremely resilient. And so from that standpoint, I think access to the municipal bond market in the public way is in due course and is not necessary at this particular point. Having that as an emergency backstop, should there be shocks to our market in the future, is always important. It's also important to note the difference between what was used for the corporate market versus what was used for the municipal market. The corporate market was a secondary sort of platform, which helped those investors who already had actual bonds, corporate bonds. The municipal liquidity was a direct loan to issuers. Different ways of stabilizing the marketplace really serve this purpose, and I think having that lever going forward is important. But thank God we have a municipal bond market that's extremely resilient.
Thank you. And Mr. Parsons, my question to you, sir. I've looked at your study and your results, and I just wondered if you are familiar or have seen a similar study that perhaps has been done on the impact of the bond work and the costs as to Hispanic serving institutions.
No, I have not. No, I'm not aware of that.
Not at all. And Ms. McDaniel, are you aware of any study or work that's been done in the area of the impact of borrowing costs and higher fees as it's related to Hispanic serving institutions?
Thank you for that question. I think the best point to focus on there is I believe Excelencia does some great work on that, but that it's segmented because you have institutions that were predominantly white institutions becoming HSIs and often have higher capacity with getting bonds, and so there's some variance there with different HSIs, but their research speaks to that.
Yeah, well, I agree with your comment. I think you quoted Ms. Garcia that said that it's not just about including them in the population, but actually serving them. And I thank you for that comment. And I think that that's true of any institution, that they need to serve all their population, regardless of where they come from or what color. So thank you so much. And Mr. Chairman, I yield back.
The gentlelady's time has expired. The chair now recognizes the gentleman from Guam, Mr. San Nicolas. He is also the vice chair of the full committee. You're recognized for 5 minutes for questions, Mr. San Nicolas.
Thank you so much, Mr. Chairman, and thank you to all of our witnesses here today. As the representative from a territory, I can absolutely attest to the fact that triple tax exemption for municipal debt does greatly improve the market environment for the issuance of municipal securities. Guam, as a territory, does enjoy triple tax exempt status for the bonds that we issue, whether they're revenue bonds, whether they're GO bonds, whether they're limited obligation bonds. And so I would fully endorse, Mr. Chairman, as an option, triple tax exempt status for HBCUs and for minority serving institutions as a solution for us to bring down the cost of debt for these institutions. Another option, Mr. Chairman, would be perhaps to also consider having land grant institutions classified as agencies of the U.S. government, similar to Fannie and Freddie. That way, they also have their debt with implied full backing of the full faith and credit of the United States government. That would also greatly help in driving down the interest costs for the debt that they issue. I know that we are discussing the cost of issuing debt, particularly on the underwriter side. But I wanted to highlight, Mr. Chairman, that the biggest cost of debt, of course, is the interest rate paid on the debt. And the triple tax exempt status will absolutely help to lower interest rates for these institutions. In fact, Guam is so successful that we oftentimes have our debt oversubscribed. And so, Mr. Hall, I wanted to tap into your expertise here on oversubscriptions, which basically drive down interest rates even below the coupon rate. What is a typical oversubscription that would be healthy?
Well, that's a very, very, very important point. And you're absolutely right that creating peak competition for bonds drive yields downward. The good news is that our market has had an infusion of regulatory changes in recent years. And one of the important features now is the expanded inclusive of municipal advisors in the process that have a very defined fiduciary role. Why they're important in the underwriting process, when you get oversubscription in an offering based on investor interest, typically our municipal advisors acting on behalf of the issuers ask that the underwriters actually lower yields to reduce that subscription. And so that actually improves the pricing performance during the course of a transaction of an issuer. And that's one of the sort of helpful support systems that the regulatory framework now allows for to ensure that oversubscription inures to the benefit of the issuer.
And so what would typically be like a healthy oversubscription, maybe 4 times oversubscribed?
You know, I'm reticent to say because it's always contingent on the deal size, type, credit of that particular day in those particular market environments. But I would say a healthy subscription that would require maybe revisiting the bond's offering price would be over 2 to 3 times.
Thank you so much for putting that on the record. And Mr. Chairman, I wanted to get this on the record because even if we do get triple tax exempt status for HBCUs, there is still a danger that we're not going to get best interest rate pricing due to oversubscriptions. And Guam, Mr. Chairman, has a horrendous oversubscription problem. And I think that kind of circles back to underwriters not pricing the debt properly. We had, and for one example, a debt that was issued on the month of June, and then another debt that was issued in the month of August, both by the same agency, both a revenue bond, both for over $100 million. The coupon rate on the first debt was 5%. The coupon rate on the second debt was 3.61%. The 5% was oversubscribed by 21 times. And the second debt was oversubscribed by 1.2 times. And so as we seek out ways to reduce costs to our institutions, we need to be very mindful of the fact that the underwriting fees up front are one thing, but we need to also protect institutions from mispriced offerings that are going to result in interest expenses. $100 million at an 89 basis point differential over 30 years of a debt is a $26.7 million interest expense. Thank you, Mr. Chairman.
The gentleman's time has expired. And the chair will now recognize himself for 5 minutes for questions and statements. And my first statement will go to Ms. McDaniel. Ms. McDaniel, as it relates to this subcommittee, I think you may have made history today by announcing your pronouns. And I think I'm going to join you in making history, if it is such, and announce my pronouns as he, him, his. So maybe you're changing the world today, Ms. McDaniel. You know, language is very important, which is one of the reasons why I appreciate this president, President Biden. He uses the language of the suffering. If you want to change the status quo, you have to change the language. You cannot use the language of the status quo and change the status quo. And I appreciate President Biden. Which takes me to you, Mr. Parsons. Sir, you have indicated that you found that HBUs pay an average of 20% more to issue bonds than similarly situated non-HBCUs. My question to you, Mr. Parsons, is this a case of this being institutionalized, since it applies to HBCUs? And if you'll give me a brief yes or no, I'll then follow up.
Can you please clarify your question, what you mean by institutionalized?
Is it such that the institutions that are promoting, producing, promulgating, and perpetuating this circumstance, are they doing it not because they want to discriminate necessarily, but it's institutionalized in their habits and their norms?
The results of our findings are consistent with investors.
Okay, well,
Preferences of investors.
They work for institutions, do they not?
About half of municipal bonds are owned by just mom and pop retail investors, and about another half are owned by institutions.
Okay, those that are representing institutions, let's just talk about that. Is this something that is institutionalized?
Our paper does not address that.
Just asking you for your opinion. No penalties today.
No opinion offered.
Okay, let's go to Ms. McDaniel. Ms. McDaniel, do you see these circumstances as being institutionalized? This 20% excess charge?
It would certainly appear that way. Sorry, you asked for yes or no. My opinion would be yes, that it seems that way.
Yeah. Well, you know, I tend to take people to the edge, so please forgive me. But it's just something that a person who's a liberated Democrat does. I'm not a part-time freedom fighter. So sometimes you bring your full-time fighting to the arena where it can be most beneficial. So if this is institutionalized, is it institutionalized discrimination? Ms. McDaniel, is it institutionalized discrimination?
It would certainly seem that way. Judging by the outcomes, I would say yes.
Well, let's go to Mr. Fisher. Mr. Fisher, is this institutionalized discrimination?
I believe so when we're discussing institutional investors.
Thank you. As it relates to institutional investors is a good preamble for my commentary, and I appreciate you calling it to my attention. As I move next to Mr. Hall. Mr. Hall, is this institutionalized discrimination?
So, Chairman Green, I have not studied that. I can tell you that what I saw in the study that pointed to taste-based discrimination is not something consistent with my experience in the marketplace. And I don't think the study done at the time that it was done really benefited from the transformation that's taking place in our market that will make a study like that today a little bit more inductive. So I can't conclude that I see that there's been institutional racism, sir.
Okay. The chair appreciates all of the answers. I have but 22 seconds left, and I try to be a good example for the rest of the committee. So I'll just close with this comment before I give my official closing. We know and probably can take judicial notice of the fact, I say judicial notice, we do it in court, of the fact that these institutions have been discriminated against in the past. And I think that we probably have to do more to acknowledge and work to acknowledge what the current circumstance is. I'll leave it at that and yield back the balance of my time. No additional persons to ask questions. And as a result, the chair will now thank the witnesses for their testimony and for devoting the time and resources to share their expertise with this subcommittee. Your testimony today will help to advance the important work of this subcommittee and of the U.S. Congress in addressing lending discrimination and systemic racial inequality. The chair notes that some members may have additional questions for this panel, which they may wish to submit in writing. Without objection, the hearing record will remain open for 5 legislative days for members to submit written questions to these witnesses and to place their responses in the record. Also, without objection, members will have 5 legislative days to submit extraneous materials to the chair for inclusion in the record. I remind members to submit your written questions and materials for the record to the email address provided to your staff. This hearing, greatly appreciated, is now adjourned.